Yeah, we appreciate you being here. We're talking about ending the year so strongly. Why should I think about investing internationally when right here, right now, looks pretty good?
I think almost for that reason. You've seen such a strong uptake in U.S. stock prices and valuations. And what has basically been ignored are what's happening in overseas markets, specifically in the European markets, and to some degree, even some of the Chinese companies have been continued to do well in terms of earnings growth and business success, very strong business fundamentals. But these valuations are at near 20-year lows in terms of a differential between non-U.S. and U.S. stocks. And all you have to do is look at the EFA index performance versus, say, the S&P, and you see this huge gap continues to open. And I believe at some point this becomes extremely unsustainable, and you have a closure of this huge valuation gap.
I'm wondering, let's just take Europe, for example, first. I'm wondering about the elevated risk there, COVID and otherwise, relative to what's happening in the United States. I have had people come on, my show, and we've heard from others, too, who say Europe presents a tremendous opportunity in the year ahead in a number of sectors. But how do you deal with the prospect of shutdowns and closures? And even though valuations seem attractive at the current time, you do have to deal with those potential risks.
Yeah, I think you have these risks all over the world. But what appears to be happening, especially with this latest new variant, is that people are beginning to come to the realization that we as a society have to live with this. And you see it even happening in the United Kingdom, which in the past has been very quick to jump to restrictions. They have really tried to back off and taken steps to adapt to what's happening. And I think as this begins to happen more and more and more, if you see less reactive in terms of economic shutdowns, this actually becomes one of the opportunities. And when you add this to the amount of pent-up demand and high savings, and really what has been the lack of consumer expenditure in the last year, especially in places like Europe, you see the potential for this fuel to lead to very strong economic growth. The fuel being the pent-up demand and high savings. People have basically been sitting on their bank accounts looking for things to spend their money on. And I think as we get to the back end of this pandemic, places that have been slower to open, like many of the European countries, will see some of the stronger economic growth, thereby helping corporate earnings in Europe.
Do you think, David, that given that picture, we could see higher inflation in those regions as well? With the exception of the UK, many of them haven't been experiencing the same type of inflation that we've had here in the U.S.
Yeah, there's been a little uptick. You may have seen the Spanish inflation number today. I mean, it is picking up everywhere, as we know. And I think we are going to continue to see this. And I think more importantly is the impact this has on interest rates. You're starting to hear a lot of noise, even out of Europe, that it's time, the noise saying it's time to end the negative real interest rate experiment, which has basically been in place post the global financial crisis. I think what people really haven't gotten their hands around is the fact that combined with the end of the pandemic, the slow end of the pandemic, higher inflation, higher economic growth means that we're going to have at some point in the medium term interest rate normalization. And if this happens, a lot of these European financials, for instance, which are trading at valuations well below book value, and who should start to see higher earnings and higher distributions to shareholders, look to be extremely attractively priced. And I think one of the key places to be going into 2022 and 2023.